Where's this market going?
At the moment, it's really simple. It's going up.
Okay.
And I know the argument. We're what, 8% away from the all-time high, which was back in May of 2008. 33,233 was that high point.
Okay.
We're approaching it. And considering what's happened in the last 2 years, people are saying this is the craziest thing that they've seen. But the point is, crazy or not, the market is going up. And we can delve into, is there value and what's the market looking for. Right now, we're heading for it. And I think we're going to get there, probably in the next couple of weeks.
You reckon so?
Yeah.
Are we too late? I mean, if I'm wanting to buy into the market now, have I missed it?
You've missed the easy money. Look, the easy money was a year and a half ago. The problem with the easy money, it's the brave money. Buying in the middle of 2009, you've done spectacularly well, but it took huge amounts of courage. And I think that's often the case. Easy money requires that courage.
Just give me a bit of the return on that courage. If you had bought when you said in 2009, and you're sitting on that money now, what have you made?
Somewhere, depending what you bought broadly, 60%. Which is a phenomenal return.
Over 1 year?
Well, it's a little more than a year.
Yeah.
We're probably looking at maybe a year, 15 months, maybe 18 months. Phenomenal return. But it's that risk-reward. Your risk was high. Middle of last year, the world was teetering on the brink of collapse. I mean, it was late March 2009 when Ben Bernanke said the magic 2 words, green shoots. And that was the bottom. We haven't been lower than that since then. And everything went completely and absolutely crazy. But it's still, one man said 2 words, so it took the courage. So it comes back to that risk reward. You were taking the risk. You've been given that reward. People like Warren Buffett will say to you, you want to be buying when there's blood in the streets. A great phrase. Again, it's that level of courage. If you were stepping in and doing it when everyone else is selling, when everyone else is saying it's game over, there's nothing left, that's when you're really going to make the huge profit.
Now, okay, little old me and thousands of other people like me, that's why we try and do this show. What should we be looking at buying into in the market? I mean, should we be going with your standard bits and pieces? I mean, I look at, I've got little bits and pieces around. I look at my Satrix 40, for example. That last time I looked was up 4.8%. My Satrix Divi was up 45.8%. Is that what we should be looking at doing, normal guys like us?
Sure. I mean, look, an exchange-traded fund, your Satrix 40, your RAFI, your Satrix Divi, and there are other exchange trades from other, ABSA's got them, Nedbank's got RMB, are, to my point of mind, absolutely the best thing out there for the person in the street. And it's also a case of, don't take everything you own and drop it in the market tomorrow morning. That never makes sense. It didn't make sense in March of last year. In hindsight, it did. But at that point in time, it didn't. It doesn't make sense today. There are 2 things we need to do. Firstly is understand, with Satrix, you can do direct debits, you can do monthly, you can do small lump sums of 1,000 Rand or monthly debits of 300 Rand, so you can trickle that money in. So, yeah, sometimes
Is that what we should be doing? Trickling money into the market?
Trickling in, and then giving it time. Don't expect this to be a minimum time frame. If you're getting into the market, you've got to have a minimum time frame of 3 to 5 years.
Okay, so end of year coming up, maybe some people are going to get bonuses and they're going to think, I want to put some of this into equities. They should not be taking that lump sum, 20,000, 40,000 Rand, whatever it is, and just going wham, straight into equities there.
No, I mean, I never suggest. I mean, simply because, in truth, actually calling a market, in other words, timing it perfectly is frankly an impossible science. I mean, if anyone could do that, if we could, we would all be driving Ferraris by now. It's getting into that market. And whilst, the problem with putting it all in, dropping 40,000 and say on the 1st of January, is that if it falls buying with 30,000, 40,000 becomes 39, you're going to suffer great pain and suffering. You're going to feel like an idiot. You're going to hate you and me and everyone else on this channel. There's going to be huge pain and suffering. Of course, if it goes to 41, you're going to be the smartest. You're going to go out there to your colleagues and say, I'm a stockbroker. I say to folks, you got 40,000, cool, divide it into 6 blocks, put 7,000 a month for 6 months. Yeah. In hindsight, you might then look back and say it was better to have put it in but what we're managing is fear, it's managing greed, it's managing that emotional pain of seeing things fall down, and it's spreading it across a bit of time, and it potentially is going to take some of the gloss off your return, but it's going to take some of the ugliness, the
pain away as well.
Correct.
Yeah. Question in, and you're quite welcome to send any questions through at any stage. There's the email address to send your questions through. Question in, financial and media experts all advise that the shares of large global companies in the US, UK and Europe offer great value for long-term investors and are relatively cheap. Please can you tell us exactly which companies we're talking about here? It does, though, raise the question, do you have to go offshore? Because if you're investing locally in the likes of BAT and BHP Billiton and SAB Miller, their earnings are offshore already.
Of the top 40, which is our 40 biggest companies in the market, makes up more than 90% of the size of the market, the vast majority of them earning the majority of their profits offshore. That offshore might be, in ShopRite's case, Africa, Standard Bank's case, predominantly emerging markets, as you mentioned, a British American Tobacco around the world, MTN in emerging markets. Then you've got your old mutuals, you've got your SAB Millers. So do you need to physically move money offshore? There are only two reasons in my mind to do that. One, if you plan to one day go there and spend the money there, because you can't remove the currency risk. You take it there, you bring it back, you've got that risk. So if you want to invest in America and one day you plan to be in America and spend the money, sure. Or if there's a company you want to buy that you simply can't get it or an allied company in South Africa, Pepsi Cola, for example. You know, we've got SAB Miller, but they're on the alcohol side. We don't have a soft drink company in South Africa. You want exposure to Pepsi Cola, then you physically need to go offshore.
So in terms of what Pravin Gordhan said a short while back about you can now take 4 million rand a year offshore. I don't know who the hell's got 4 million rand a year to take offshore. Yeah. You wouldn't say take some of that money, let's come back to your bonus. You wouldn't say take half of it, put it into equities here, and take half of it offshore to put into equities offshore.
No, short answer, I don't. I mean, particularly, again, we're talking the person in the street to whom ETFs is probably the best idea. They look at an American, they want to buy X. In truth, most people are not brilliant. Stock pickers don't have sufficient information, notwithstanding that now we're talking about America, an entire continent away, access to information and the like. I know, the internet and Google, it's there, but it's much easier at home. We understand these brands. We're shopping at ShopRite. We use MTN and the big banks, etc. That said, to the point, we're getting the exposure already via your Satrix 40. You're earning money in all sorts of currencies and all sorts of territories around the world. We can get a little bit smarter. Deutsche Bank offers what they call their X market, which is Satrix 40, but in international markets. So there's one for Europe, there's one for the UK, there's one for Japan, there's one for the world, and there's one for the US. So on the JSE, in rands, in cents, you can get pure 100% offshore exposure invested into these international markets.
Without having to take the money offshore?
Without having to take the money offshore, which is a couple of issues. Firstly, it is the red tape. I mean, Pravin Gordhan's given us 4 million, but he hasn't removed all of that red tape, that process. And yes, there's a lot more of the exchange-traded funds there, so even if you don't want to buy an individual company, you can go for the exchange-traded fund. But it's just easier. It's right there. You've got a trading account. You can do it, again, via monthly debits or lump sum investments. It's that ease of process. It's going to be in rands because if you're living in South Africa, ultimately you're going to spend it in rands. It's going to come back one day. So it's here in rands. It's nice. It's easy. You can do it in the same place you're doing your Satrix and the like.
Now, you mentioned ETFs, and I wanted to get onto that because an article in the Business Day earlier this week about the Absa Capital New Gold Exchange-Traded Fund. I'll just read it to you briefly. It's showing the way for integration of capital markets in Africa. Absa Capital has done a secondary listing of the ETF in Botswana, and they're evidently talking to Nigerian and Kenyan authorities as well. They say in this article, if listings there materialize, it'll be the first to be listed in all 4 of the largest sub-Saharan African markets. It would be a leap forward for the sophistication of these markets and the first tentative step towards the integration of Africa's capital markets. Now, we've just had another market open up in Mauritius. In reality, is it realistic that we're going to see Africa's markets link up?
Look, I mean, Russell Opsher, CEO of JSE, absolutely would love to see that.
Well, he didn't get it right with Mauritius.
And I don't think he's going to get it right. I think a couple of reasons. A, the individual exchanges, Botswana, Kenya, Namibia, Well, most of the countries have exchanges in Africa. The exchanges like their independence, and secondly, I think the countries like it. It's almost like a tick box that a country wants to have.
Like a national airline.
Like a national airline, or that's probably a box we should leave unticked. But yeah, I mean, there's a sense that you want. It's a bit of national pride to it. It's also it shows a maturity of a capital market and the like. I think we've got an African board here. Maureen Glimini heads it up at the JSE. We've got 2 companies listed, one from Botswana, one from Namibia. I think we might start seeing more of that, where we see dual listings. As we're talking with that.
Just to come back to this ETF, though, it raises another question. It says that it's the biggest in the market, with assets of almost 15 billion. These assets are physical gold. So investors buy the ETF securities on the JSE. They get exposure to gold without any of the security risks of the next best thing, Kruger Rands. Now, in your opinion, gold, should it be shares or should it be the real thing?
It certainly shouldn't be shares. The problem with and we're seeing it certainly with, if we were looking and going back to the international, I don't think we have a quality gold mine in South Africa. Are there quality gold mines in Canada and North America and Australia? Yes. So maybe if you want a quality gold mine, another reason to go offshore. But if you're looking at our JSE, Anglo Gold Ashanti, Harmony Goldfields, then the small guys, DRD, Simmer
and the other ones who don't pay their workers.
And the ones who don't pay their workers. Yeah. I mean, what's happening? We saw from Harmony earlier this week had an update. They made more money, but they made more money because they mined more gold. They actually made less money per ounce of gold. And the trick is, so gold price goes up in dollars. Brilliant. Rand goes stronger. Whoops, takes off some shine. Hey, Eskom comes along and says, I think Harmony's Eskom bill's gone from 5% to 25% of costs. So the workers come along and want above inflation increases, etc. They're mining 3-4 kilometers down. Very expensive, very, very dangerous to do, and danger is an expense. You don't want to own a gold mine. If you like gold, you want to own gold. There's the physical, the Kruger Rand, and there's issues there around commissions, and then you've got to hide it somewhere, and under your mattress doesn't really crack it. So then it's new gold. I say to folks, you're bullish on gold, you go and buy yourself new gold. The risk is dollar gold price goes up, Rand goes down, and your Rand gold price goes sideways. 2009, the dollar gold price was up 30%, but South African investors, gold and Rands, went sideways.
Okay, I'm starting to get a headache.
We'll turn it back to simple.
Yes, let's go back to simple.